Welcome back to the channel. We are halfway through 2026. And if you are an Australian investor, you might be asking, why is my money sleeping? Let me hit you with the numbers as of today, May 21st, 2026. While the S&P 500 is up over 8.5% and the NASDAQ is absolutely ripping up nearly 14%, the ASX 200 is actually negative for the year, down over 1%. In fact, just a few weeks ago, the market was bracing for a lost year as the index fell for 6 straight days. So, is Australia broken? No, but your portfolio is fighting a battle it cannot win. Today, we are breaking out the whiteboard to diagnose the 3 structural diseases causing the ASX lag. And warning, the cure isn't coming next week. The first reason is index composition. This isn't stock picking, this is math. The global market rally in 2026 is an AI infrastructure trade. It's about data centers, chips, and software. The US market is built for this, but look at the ASX. We are 35% financials and 25% materials, miners and banks. We are essentially a 19th century economy trying to trade in a 21st century market. Armina Rosenberg from Minotaur Capital put it best: the picks and shovels of the AI boom barely touch our shores. In fact, while the US was soaring, our information technology sector crashed nearly 10% in January alone and is down almost 38% over the last 6 months. Investors are terrified that AI will disrupt our software stocks like Seek and Xero, which have been hammered. We aren't riding the wave, we are drowning in the undertow. Reason number 2, the domestic macro nightmare. While the US Fed is hinting at cuts, the RBA is doing the opposite. We are facing persistent inflation and actual rate hikes in 2026. The official cash rate just rose to 4.1%. This kills 2 things: consumer spending and bank margins, eventually. But the real killer in 2026 is energy. The Iran conflict sent Brent Crude spiking nearly 70% in a single month, hitting $115 a barrel. Australia, as a net importer of fuel, got crushed. Look at the confession season in April and May. Companies are issuing profit warnings left and right because energy costs are eating their margins. Cochlear plunged 40% in a single day. Qantas is warning of higher ticket prices, not because they want to, but because jet fuel is through the roof. The ASX is full of old economy stocks that actually consume physical energy, unlike a SaaS company in California. Third, and this is the kicker, the China demand issue. For 20 years, when the world zigged, Australia zagged because China bought our iron ore. That safety net is gone in 2026. Commodity-linked demand from China has been weaker than expected. Iron ore, the engine room of the ASX, is subdued. While BHP is holding up okay due to copper, which is needed for EVs and data centers C, we do touch AI a little bit. The broad mining sector isn't getting the super cycle boost it needs. Now, there is one silver lining here: gold. Gold miners like Newcrest and Evolution are ripping higher because of global war fears. But one shiny metal can't lift a 25% weighting in the index when everything else is heavy. So, what do we do with our portfolios? Don't wait for the ASX to catch up. It probably won't this year. The structural issues of index weightings and high energy costs aren't reversing in 6 months. Action item 1. If you want AI exposure, you have to look offshore. Currency hedging might be painful right now, but the growth is there. Action item 2. Be very careful with ASX tech and consumer discretionary stocks right now. The confession season is still rolling out, and UBS warns that earnings downgrades are likely just beginning. Action item 3. If you are staying local, look at energy. Woodside and Santos are direct beneficiaries of the $115 oil, and they are the only sector actually up on the ASX this year. The ASX 200 isn't a bad index. It's just the wrong index for the current macro environment. Don't anchor your returns to a market that is fighting physics and rate hikes. If you want to survive 2026, you need to diversify geographically. Like, subscribe, and comment below. Are you holding your Aussie banks, or are you moving money to the US? Let me know.